Hi, welcome to episode 55 of Oil Matters on Wednesday, the 12th of November. There's been much breathless excitement this morning on social media around the release of the International Energy Agency's World Energy Outlook. This influential annual set of projections helps guide member governments' decision-making on energy and climate policy, with a set of supply and demand projections to 2050, based on different scenarios for global government policy choices and climate change targets. It's no coincidence that the WEO's release occurs in the same week as the COP30 discussions taking place in Brazil. This year's WEO reintroduces, after an absence of 6 years, a current policy scenario, or CPS, which models energy supply and demand on the basis of no major change from today's suite of energy and climate policies worldwide. There are also stated policies and net zero scenarios which illustrate energy profiles given progressively more ambitious climate policy implementation. Ongoing increases in global oil and gas demand through 2050 under the CPS contrast starkly with sharp drops in hydrocarbon demand modelled under the net zero scenario. For what it's worth, Argus Consulting's longer-term oil projections align more closely with the IEA's stated policy scenario, which envisages global oil demand plateauing in the early 2030s and only declining gradually to around 97 million barrels a day by 2050. Away from the numbers, though, what has exercised all market pundits this morning has been speculation over the rationale for the reintroduction of the current policy scenario, variously attributed to political pressure on the IEA from the Trump administration, or the slowdown in Atlantic Basin clean energy deployment amid straitened financial times in the period since the pandemic. Rather than getting so hot under the collar, the social media commentariat could have conserved a lot of energy by reading a measured piece on the IEA's website dated the 5th of November, which clearly sets out the rationale for, and indeed the predictive limitations of, each of its long-term scenarios. As has always been the case, social media can at times create more heat than light. Perhaps global leaders could consider that as they formulate climate policies for the years ahead. On a shorter-term basis, crude futures have been comparatively stable in the last fortnight, with ICE Brent last night closing at $65.16, NYMEX WTI at 61.04. M1 minus M3 backwardation for Brent has eased below 50 cents once again, and discounts for FOB Urals loading in the Baltic have widened to over $19 a barrel. Refinery outages have propelled gasoline and diesel cracks higher in Asia and Europe, with European diesel cracks above $40 a barrel for the first time since autumn 2023. New US sanctions on Russian producers Rosneft and Lukoil, which kick in from the 21st of November, could potentially curtail a portion of the two companies' 2 million barrels per day of crude exports to China, India and Turkey, but could also tighten diesel supply in the broader global market. Flat price support for crude has also derived from a US maritime military buildup in the Caribbean, which could ultimately have implications for Venezuelan crude exports. There is also the decision by OPEC Plus producers to pause supply increases for January to March, while the group digests market indications around the impact of Russian sanctions and efforts by the US Congress to reach a funding deal that allows the reopening of the federal government after a record shutdown. Despite widespread expectations on paper of a growing oil market surplus in 2026, spot prices are currently holding relatively firm. Geopolitical risk, Strained tanker and port availability and continued Chinese crude stock build are keeping market bears at bay for now, though a softening of market fundamentals remains the most likely scenario for early 2026. That's all for now, but as always, be sure to check out Friday's Argus Global Markets and Petroleum Argus for more on short-term market developments, and next week's Argus Fundamentals for our consulting group's latest 2-year outlook. See you next time for another Oil Matters from Argus Media.